Well, interestingly, it's really the UK that's driving the longevity markets these days. It's the longevity market started with life settlements, which is very US focused and US driven, but that's still remained a relatively small market. And now within the UK pensions, which is a huge set of assets and liabilities, many trillions of pounds in the UK, you're starting to see a need for the pension funds and the life insurers in the UK to hedge their longevity risk. And that's leading to the longevity swap market and the growth in the longevity swap market. And really you're seeing a lot of banks who are looking to execute transactions but don't want the longevity risk, and that's getting transferred into the life insurers through longevity swaps. And so the UK is driving that market. Europe not so much, because there isn't so much of the pensions and annuities. US again not so much. There is a reasonable amount of pensions in the US, but the longevity risk is not correctly priced, so it looks very expensive. So the UK is driving that. So there's really two reasons for regulation here, or self-regulation. So one is, again, in the life settlements market, that's had quite a bad reputation and had a few fairly inappropriate people involved in it. So they're really trying to create regulatory bodies with standards, and people adhere to the standards to give the asset class a reputation where the institutions can feel really comfortable investing and think it's a clean and reasonable market. And it is a good market. I mean, there are real benefits to life settlements, so that's a positive move. The other issue you've got is really standardization. If you really want to trade stuff, you need to have some kind of standard that everybody trades around and everybody understands, so that you don't have to go through a whole load of documentation and understanding through transaction by transaction. So if you look in the credit derivatives markets, you had that with I'm trying to remember the name of the regulatory body, but they set up their own regulatory body and set standards and so on, and they're looking to do that in the life market, so that they have indices and standardized transactions, so that everybody can sign up to a transaction and just fill in the individual details of the transaction rather than having to go through all the background of it. It really should. I mean, the ambition of standardization is always to make transactions simpler and less expensive, and that should really help the market to grow and develop. If you're doing bespoke transactions, they take longer, they're more expensive, there's far more barriers to doing transactions, so people stay out of the market. As you can standardize, you basically make it cheaper and more efficient to transact, and that should bring more people into the market. Absolutely, Solvency II is going to have a big impact on the ILS market. It really will have different impacts in different ways. So if you look at the life markets, one of the things that people are expecting large growth in was this idea of effectively future profit securitization. Technically it's called VIF, or value in force. And really life companies, because they have fairly predictable future profits, used to be able to go out and securitize those future profits for cash, and that could go into capital. Solvency II actually allows you directly to use those future profits in your capital calculations, so there's no need to securitize anymore. You just get the benefit of it. So that will actually stop that market, but it's not a huge part of the ILS markets. There haven't been a huge number of transactions, some, but fairly small and not many. On the other side, in the P&C markets, it will actually allow cat bonds and insurance securitizations to count as proper hedges on your balance sheet. It will allow them to count in the same way as reinsurance. So that will be beneficial. In fact, it will allow you to take the benefit of the collateral, and it will be very high quality reinsurance. And in fact, another impact is the credit quality of your reinsurance is being accounted for the first time, which should be done, but hasn't really in Europe. So I think it will really help the cat bond market. It will help it to develop and grow, because it will help them in their capital management. It will be seen as a very high quality reinsurance, which you'll be able to take the benefit from.